Hi everyone, welcome back to the channel. On this video, we're going to be talking about the hierarchy of financial needs by Abraham Maslow. Who is Abraham Maslow and what is this hierarchy of financial needs? As well as what is the solution to this hierarchy? Without further ado, let's get right to it. So the hierarchy of financial needs was created by Abraham Maslow. And first, let's go ahead and dive into who is Abraham Maslow. Abraham Maslow lived from 1908 to 1970. He was an American psychologist who developed the hierarchy of needs. To explain human motivation, his theory suggested that people have a number of basic needs that must be met before people move up the hierarchy to pursue more social, emotional, and self-actualized needs. So this article I'm reading from a website called verywellmind.com, biography of Maslow, of Abraham Maslow. So you can reference that. It goes on to explain a little bit more about his life and his work and his study. During the 1950s, Maslow became one of the founders and driving forces behind the school of thought known as humanistic psychology. His theories, including the hierarchy of needs, self-actualization, and peak experiences, became a fundamental subject in the humanistic movement. He came up with these ideas, felt that Freud's psychoanalytic theory of Skinner's behavioral theory were too focused on the negative or pathological aspects of existence. He also felt that these theories neglected all of the potential and creativity that human beings possess. Maslow's theories were more focused on maximizing well-being and achieving one's full potential. So I'm not going to read all of this and go into in-depth more details about it, except that his studies, in his studies, he studied some of the most famous and successful people at his time, including Albert Einstein, and he realized that all humans have a common thread that kind of run through them in terms of their hierarchy of needs and what's important to them. And so that's where he came up with this hierarchy of financial needs. Now, this version that we're looking at is edited by Visual Capitalist. So now we're looking at advisor.visualcapitalist.com, hierarchy of financial needs. And so there's a little slight modification to it, but they do give credit to Maslow for this hierarchy. So this version of it is updated for 2024 and dealing with a financial perspective. So when we look at this pyramid, we see that at the bottom that all human beings have a basic need for cash flow, and that includes food, housing, transportation, and daily expenses. Once you achieve that as a human being, once you have food, housing, transportation, and daily expenses, the natural next step is to make sure you have something like a buffer or an emergency fund to protect you in the event of an emergency. And that's also where insurance comes in. Once you have that in place, then the natural next step is accumulating wealth, which includes building investment portfolios, saving for retirement, and paying down debt. And then the natural progression from there is financial freedom, or what others like to call retirement. Financial freedom is a better term. And in your financial freedom stage of life, you look for long-term care, retirement savings, children's education, and vacations. And finally, your legacy, which is generational wealth. And then that leads to your estate planning, tax planning, and business succession planning, right? So this pyramid here is a very nicely laid out as a diagram of the hierarchy of needs. And though we all kind of start at the bottom of the cash flow and basic needs, there's no rule or law that says how this flows. So some people will jump straight to financial freedom or blend the different hierarchies here, the different stages, and they don't necessarily go through every stage, cleanly. So that's normal and natural as well. Some points to make here. It says that just 47% of adults would have enough savings to cover 3 months of expenses. And that's scary, guys. The fact that, only 47% of adults can live off of 3 months savings if there was an emergency is a scary thought. And that's one of the first things that we have to address is our emergency fund. It also says that only 29% of Americans over 50 feel very prepared for retirement. And feeling prepared and being prepared are two different things. So if only 29% feel prepared, the percentage of people that are actually prepared are even lower, right? And so this is a problem, and this is something we need to look at as a individuals in our lives and for our families. And so the one solution that solves for all of this, it provides you with an emergency fund, it provides you with a retirement fund, and it provides you with an opportunity fund. So if there is an opportunity for investment, you have funds available to access. Is going to be a whole life insurance policy with a major mutual company that is properly designed with maximum cash value. And with the major mutual, they're going to be paying dividends on that cash value growth. The growth inside that policy is going to be tax-free growth, and you're able to borrow against the policy for your emergency fund, for your opportunity fund, and for your retirement fund. And then, of course, it is a life insurance policy, so it has a death benefit, which is part of your legacy and generational wealth. And of course, that becomes part of your estate planning and tax planning. So the one product that can solve for that is a whole life policy with a major mutual. Let's take a closer look. You're going to see this is an example of a 39-year-old male who is does not smoke, no tobacco. And so we put on here a 30-year PUA rider, paid up additions, which is the cash vault, which then also increases the death benefit. So right out the gate, you see that this person has a contract premium of $111,048 a year. The net cash value, and this is the guaranteed column. So after year one, he has access to $95,380, and that's guaranteed. He can borrow up to 90% of that column. And that's why this is so powerful, because when you put your money in other products like CDs, IRAs and 401ks and other investment vehicles, your money is locked up, it's trapped. You can't get access to it. This money becomes available immediately. The illustration is showing it to you 1 year later, right? However, based on the lump sum, which you can see at the top right here, the base premium is only $920.70 per month. And then the lump sum cash value, which is a vault or a bucket that he can put his cash into instead of a savings account, he's putting his savings into the life insurance policy, into this cash saving space. And that is what's going to start growing compound interest and tax-free growth. And on this side, again, we're looking at the guarantee a year later. Now, he doesn't have to wait a year. As soon as that money clears, within about a week or two, once that initial lump sum is put into the policy, he can borrow against that immediately. There is no delay. You don't have to wait a year to get access to start leveraging and using the cash value in your policy. Now, to properly practice infinite banking, as this is called, this strategy is called infinite banking. It's not just borrowing against the policy and using it in your investments or in your life, but it's paying it back. That's what completes the loop of infinite banking, is paying it back to your policy. However, when you borrow money from a bank, the bank tells you the due date. It has a late payment. If you don't pay on time, there's a credit hit. You'll have a derogatory remark on your credit. With your insurance policy, you're not going to have a late payment. You're not going to go to collections. You actually don't have a due date. So you have flexibility. Now, I advise and recommend treating it like a bank would treat you. So you set your payback terms and treat yourself like a bank. So this would be the bank of Sebastian, or the bank of Laura, or the bank of Jim, or the bank of whoever you are. Put your name behind that, and you want to treat it like that. And your goal and objective should be to pay back whatever you borrow against the policy as soon as possible. However, you have flexibility. And so there is no deadline or urgency. If you don't pay it back in that timeline, that you're going to be penalized with a late payment, or you're going to have a mark on your credit. There's protections built into the policy where even on your demise, if a portion or a balance of that policy loan was not paid in full, the death benefit will pay for that balance. Now, that portion could potentially have a tax consequence that gets paid for on the death benefit, but it's nice to know that if I can't pay it all back, or I die before I'm able to, then my death benefit protects my policy. Okay, so this is just year one. Right now, if we look over to the far right column, we see the dividends column. So this is the dividend scale for this insurance carrier. They're offering 5.3% dividends for this year. The dividends fluctuate from one year to another. So next year, the dividend could be 5.25 or 5.35, and therefore they can't use the word guarantee. But you can go back over 100 years and see that these major mutual life insurance companies have always paid their dividends. And so this is something you can bank on. You can expect this result. This is a safe place for you to store your money. This is a safe place for you to create wealth where you're able to leverage it and invest it, leverage it for a rainy day, leverage it for retirement. And the best thing about this is that this insurance carrier even gives you living benefits, which means that if there's an event where you're unable to care for yourself, there's 5 basic living requirements like putting on your clothes and feeding yourself. If you're unable to do these 5 basic things, then you're able to get an advance from your actual death benefit, which you don't have to pay back. Or if you have a chronic illness, or if there's a medical condition where you're unable to care for yourself, the policy allows you to take an advance from the death benefit, which you actually don't have to pay back. I like to think of that as life insurance, and the death benefit is really death insurance, because that only gets released upon your death, where the living benefits are available to you as an advance from the death benefit under those circumstances. So you have something now in your possession that is liquid, that is growing compound interest tax-free, that is protecting your death and your wealth for the next generation. And in most states, your money that is stored inside of a life insurance policy is off limits from creditors or from any lawsuits. So your money is safe, secure, and protected, and you have access to it. So let's just go down on the dividends column and just kind of see what happens year after year as you continue to invest and put your money into a policy like this. And I don't even like using the word invest, because you're really not investing, you're saving. You're saving your money, and then your investments are what you're going to do outside of the policy. So when you borrow against the policy to invest in your business, or invest in the stock market, or invest in whatever you want to do, pay for your kids' college tuition, pay off debt, buy a new car, whatever it is that you need or want to do, you can do that with these funds. And so this column here is really your saving space with the dividends, and this column here is the guarantee, which is a legal guarantee that the insurance company provides you, right? So some folks like to look at this side. I like to look at this side because I know that more or less I can anticipate this type of performance out of this policy. So if we look and we go down to, let's say, year 20, we have a cumulative premium that we've put into the policy of 2.2 million, but we have cash value of 3.2 million. So our policy grew with compounding interest and dividends $1 million over 20 years. And we have a $6.7 million death benefit. I mean, guys, this is a safe and secure place for you to protect your money, where you have access to an emergency fund, you have access to a opportunity fund and a retirement fund, and it solves for all of these problems that are in your hierarchy of financial needs, because you can access the funds while it's continuing to grow. Does that make sense? Let's take a quick look at a smaller example. So same age, someone who is 39 years old, instead of putting in $100,000 in savings a year, they're only putting in $10,000 in savings. Okay, so their annual premium is $11,773, and you can see that base cost, the base premium, is $147.79. So their cash bucket is $10,000. And you'll see after year one that available to them is $9,642 in the guaranteed column. Available to them in the dividend side is $10,162. Let's fast forward to year 10. You could see that's $131,422 in cash value growth. And this is just continuing to compound. Now I'm going to go ahead and show you that if you look at this last column at the bottom here, there was no premium paid on year 32. No additional money put into the policy to fund the cash bucket. But the previous year cash value was $672, $672,310. And on that 32nd year, it grew, and now the cash value is $699,670. And that's because of the power of compound interest with the dividends. The death benefit also grew. Even though there was no more premium and no more money put into the savings account, the policy grows. And so if we continue to go down on an example where we could see further years, you'll see that that policy continues to grow. Okay, so that's it, guys. I hope that this video was of value to you. Make sure you take the time to research Abraham Maslow, learn about the hierarchy of financial needs, and if you're considering a whole life insurance policy as a solution, make sure that you reach out to me. You can schedule a free consultation, and I can show you an illustration of what a policy would look like for you. So take great care. Make sure you like, subscribe, and share. God bless you.